The major US stock indices continues to consolidate for the second consecutive session ahead of today's key risk event, which is the FOMC meeting. And very interestingly, the Nasdaq 100 and the Russell 2000 managed to outperform yesterday with modest gains. The US dollar was mixed with two key outlier that has taken shape yesterday. Number one, the Aussie dollar managed to outperform against the US dollar. And on another side of the spectrum, the yen weakened significantly on the intraday basis after BOJ Governor OANDA remarks. Interestingly, gold XAU/USD volatility has slipped to a 2-month low ahead of today's FOMC meeting. Very good morning to all. I'm Kelvin here. Welcome back to today's Daily Dose of Market Insights. So before we kickstart, let's have a quick look at the disclaimer first. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. Okay, so as usual, before we jump straight into the gist of today's daily dose, which is the full suite of intraday technical outlook on all the broad-based cross asset classes, let's have a quick recap what has taken shape yesterday. So yesterday we have a very interesting movement on the FX market. So before we jump straight into the news that drives the FX market, we could look at it over here. Is this the 5-day rolling performance of the US dollar against other major currency using the dollar as a major pair? So what we could see over here is something like a K-shaped performance. At the top of the K, which is the upper K, the dollar strengthened significantly against the Japanese yen, which is up by 0.96% on the 5-day rolling performance basis, but weakened against the Aussie as it's down negative 0.55%. So these are the two key outlier in the FX market yesterday, which is the Aussie and as well as the yen. So why the Aussie strengthened pretty significantly against the dollar, which I explained in my yesterday's daily dose, and I also highlight that the Aussie dollar was my chart of the day yesterday due to its rather interesting positive technical element. So the reason why the Aussie dollar continues to trade rather firm against the US dollar yesterday was due to this hawkish policy guidance out from RBA Governor Bullock press conference yesterday, after RBA has decided for the third time to cap its cash policy rate unchanged at the 3.6%. So what she mentioned during the press conference, she called out an end to a truncated easing cycle. So that actually potentially more or less nail in the coffin that the current interest rate cut cycle by RBA has ended, and policymakers right now are gauging whether a pickup in inflation requires an extended interest rate pause or even a switch to tightening over here. And with this tonality, the Aussie dollar managed to trigger a positive feedback loop due to a spike up in the policy-sensitive government bond yields over here. And also money market futures contract in Australia almost fully priced in a potential interest rate increase this coming next coming May in 2026. So that causes the Aussie dollar to trade at a firmer bid, still holding above our key short-term pivotal support at 0.6605. So later I'll touch on more about the technical chart on the Aussie dollar. Now up next will be the yen, which is weakened significantly on the intraday basis yesterday. Why? Because yesterday BOJ governor gave out a rather mixed comment over here. But he do mention about this comment where he stated that recently long-term rates has been rising at a somehow rapid pace. So actually he's referring to the spike up in the 30-year JGB yield to record high, and as well as the benchmark 10-year JGB yield that hit the 18-year high at the start of this week. So he also mentioned that after highlighting this rapid upward movement in the longer 10-year JGB yield, he mentioned that if this longer-term interest rate rise sharply in deviation from normal market movements, BOJ intended to take flexible measures. So what I mean by flexible measures, that he could come in and instruct BOJ to start purchasing government bonds again. All right. So that ultra, we call it dovish QE, we call it modified QE, where BOJ purchased bonds as well as purchase stock-related ETF in the Japanese stock market, in the bond market. They have already removed this policy 1.5 years ago. But after BOJ UDA remarks yesterday that BOJ intended to actually come back into the bond market and start purchasing long-term bond to cool down any rapid upward rise in the longer-term 10-year JGB yield and even the 30-year JGB yield if they deviate away from their fundamentals. So that causes the dollar yen to spike. That means, i.e., the Japanese yen to weaken past the US dollar, shooting past above the 156 psychological level. All right, and back to the US stock market over here. So US stock market was rather lackluster yesterday, another day of consolidation ahead of today's key risk event, which is the FOMC meeting. So what we could see over here is that the SPX managed to close down modestly, I would say a minor decline of negative 0.09%. And the outlier was the Nasdaq 100, which managed to gain 0.16%, as well as the highly much more levered balance sheets of the Russell 2000 small cap company, which potentially will benefit more of benefit from a dovish Fed, given that they are much more highly leveraged as compared to the other mega cap technology stocks listed inside the Nasdaq 100 and the S&P 500. So the Russell 2000 managed to gain by 0.21% yesterday. So net overall, it's more like a price action consolidation, in my own opinion, rather than the start of a medium-term corrective decline phase for the major US stock indices. So if you look at the heat map of the S&P 500 over here, what we could see is that there are pockets of green in the mega cap space yesterday, where Google managed to up, Google/Alphabet managed to up 1%, Amazon 0.45%, the Tesla up 1.27%, and Microsoft managed to gain modestly by 0.2%. All right, and Nvidia down slightly, negative 3%, followed by Apple, which is also down by the same magnitude of negative 0.3% overall. All right, so if you look at the FOMC CME Fed Watch 2 today, in terms of the pricing expectation, more or less, market participants expecting a 25 basis point cut by the Fed today. So rather this will be a hawkish cut or a dovish cut. That actually dependent on two things going forward. Number one will be the release of the dot plot today, and as well as how Fed Chair manage his, we call it a Q&A session after the FOMC outcome has ended at 3:30 a.m. Singapore time. So let's talk about the dot plot first. So what is this dot plot over here? So the dot plot is being released in every 3 months. That means every 3 meetings, they will release the dot plot. So the previous dot plot was released in September over here. So if you go to the FOMC meeting calendar in the Federal Reserve website over here, any meeting dates that has a little star at the end indicate that they will have the release of the dot plot, right? The previous dot plot was in September, and the next dot plot, which is the last dot plot for this year, will be today. All right, so that is going to be released together with the outcome of the FOMC meeting at 3 a.m. Singapore time, which is Thursday, 3 a.m. Singapore time. So why is this economic summary of economic projection, or you call it dot plot? It's actually the median projection or the median forecast among FOMC members. What's their view like in the short run, long run, and medium term run for the US economy in terms of economic outlook, labor market outlooks, if you look at unemployment rate, inflation trend outlook in terms of core PCE number, and as well as the absolute level of Fed funds rate at the end of each respective year going forward. All right, so that is a very important, we call it signaling impact towards the market in the form of an indirect forward guidance by looking at the changes in this median projection on the aggregate by FOMC members. So if you look at the previous dot plot over here, clicking on the September one, let's have a quick look since we are today FOMC day. So I want to talk about more about this. Oops, sorry. Let me go back. I think I shouldn't click the PDF file. I should click on the HTML file for a better visibility, okay, over the screen. So let me expand my screen larger. So I think this should be large enough for you guys. All right, so basically there are actually changes in real GDP. So that is talking about potential economic growth. So market participant now will be looking at 2026, 2027, and 2028 over here. So previously the projection, okay, was at 1.8% for the September one. All right, so always at the top row will be the latest projection. Then this was the previous projection over here. So for GDP growth in the last September projected meeting, FOMC members on the aggregate, their median projection was a slight upgrade of GDP growth in 2026 to 1.8%, in 2027 to 1.9%, and even in 2028, 1.8%. And the long run, it should hover at 1.8% over here. And what's interesting over here is that the unemployment rate was also being lowered compared to the June projection. So the unemployment rate is at 4.4%, lowered from 4.5%, and for 2026, all right? And for 2027, it has also been lowered by 1 basis point for 4.3%, and it continues to hover at a stable rate of 4.2% in 2028, and in the longer run at 4.2%. So market participants will be looking at this unemployment rate pretty closely. Why? Because the last ADP employment figure number came in worse than expected. So ADP is a privately compiled number. The non-farm payroll data that has been not released in the last 2 months will have a delayed release next month. All right. So if we were to look at unemployment situation in the US based on privately organization compiled numbers, that has been rather soft in the last 3 months or so. So market participants will be gauging whether the dot plot will be revised downward for the unemployment rate for 2026, 2027, and 2026, 2027, and 2028, and even in the longer run over here. And that also potentially could actually see a reduction on the change in the real GDP number as well, because change in real GDP number and unemployment rate comes with a kind of a indirect correlation. That means if you start to see a bump up in the unemployment rate, potentially the forecast or the projection from the real GDP number change should came down lower as well. All right. And now looking at the core PCE price inflation, right? Market participants will be more focusing on the core PCE price inflation rather than the headline numbers that tend to have much more volatile components like food and energy. So previously, the core PCE price inflation for 2026 has been bumped up to 2 basis points from 2.4% that was previously projected in June, all right, over here. So for the September projection, it was bumped up to 2.6%, but still maintained at 2.1% for 2027, and it penciled in at 2% for 2028. So that potentially allows the US Federal Reserve to make its target by the time the PCE inflation trend will start to temper downwards to 2.8%. So bear in mind that the latest PCE number for the month of September, it actually came in at this 2.9%, which is still rather high and higher than the higher than 2026 forecasted or projected print. So market participants will be looking at will there be an upward adjustment for 2026 and 2027 higher, given that the core PCE price index is still rather elevated above 2% over here. And also the next thing to look at for will be the absolute level of the Fed funds rate by the end of 2026, by the end of 2027, by the end of 2028, and the long run. All right. So previously the long run was no change at 3% over here. So comparatively, if you look at the current Fed funds rate right now, which is at 3.75%, market participants expecting to cut down lower to 3.5%. So given that at 3.5% to 3.77%, that cut has been penciled in today. So long run, the Fed desired to be 3%. That means, i.e., there could be only 2 potential interest rate cut going forward into 2026. All right. I mean, there shouldn't be more than that, given the fact that the long run is at 3%. So market participants will be looking at, very interestingly, the 2026 level, because for 2026, it was previously at 3.4%. It has been lowered. So this 3.4% potentially could be lowered much more further, given the fact that the core PCE, given the fact that the labor market remains soft, and also due to the fact that we have this incoming dovish Fed chair that will take over Fed Chair Powell next year. All right, so that could have an influence in how the US Federal Reserve official do their so-called median projection over here. So it's very interesting to see whether how this rate will change, especially for 2026, that is being slightly lowered from the June projection of 3.6 at 3.4%. But being at 3.4%, that only potentially imply what, less than one interest rate cut based on the expected Fed funds rate that is coming to be lowered today at 3.5%. So 3.5% minus 3.4%, that's only 0.10%. So that is less than a traditional 0.25% cut by the Fed in every meeting if there were to be continuing cutting rates going forward. So it's very interesting to see how this adjustment would change at this point in time. And also given the fact that this 3.4% at 2026 is higher than what market is expecting by the Fed could potentially do next year, by looking at the CME Fed Watch 2 under the aggregator tab, where we are able to see the probability of Fed rate cuts going forward into 2026. So what the market expecting over here is that the next potential cut at a higher chance of 96% could potentially come in only in June next year. All right, so previously we have about 70+% that may come in on either March or April. So that odds has been reduced significantly yesterday or 2 days ago, and now the higher odds of the fourth cut that could be engineered in 2026 will come in further on the 17th of June. So despite pushing down the rate cut down the calendar, but by the end of 2026 over here, the last meeting of the year of 2026, that will be at the 9th of December, 89.85%, so 90% chance that the Fed funds futures market traders have priced in based on the latest price action of their trading activity, that the Fed funds rate will be lowered by the end of 2026 to 3% to 3.25%. So that actually indicate potentially at least 2 interest rate cuts of 25 basis points each for 2026. So this 3% to 3.25% is much, much lower than what the Fed has penciled in or projected in the previous dot plot release in September. So this 3.4% likely were to be reduced lower, but how low will it be reduced? If it starts to come in within market expectation of 3% to 3.25%, more or less, it actually a signal that the Fed will continue to do its interest rate cut cycle going forward into 2026. And if it starts, this number starts to get lowered below 3% over here, and that could that could mean for 2026 that the US Federal Reserve is signaling a much more a deeper interest rate cuts. So it all depends out depending on how the dot plot is being framed up or projected going forward, and that should start to change market expectation in terms of the indirect forward guidance from the Fed. And also bear in mind that it also depends on how Fed chair wants to handle the Q&A session when it comes to the Expo's meeting press conference. That will be half an hour later at 3:30 a.m. Singapore time tomorrow, Thursday, early Thursday. All right. So that also explains why we start to see 2 days of price action consolidation within the FX market. Despite that, overall, if you look at the US dollar index over here, it still continues to trade in the consolidation range, where price action still managed to be kept below the 50-day moving average and the 200-day moving average and the 20-day moving average, coming very close to the intermediate resistance level at 99.25. All right, so that's sum up the first segment of today's daily dose. So let me now move to the second segment, which I will cover the intraday technical outlook segment. All right, so before that, let me expand my screen. All right, over here. Okay, so I think that's fine. That should be good. So let me now touch on the intraday technical outlook on the FX market first, starting with the euro dollar over here. So the euro dollar continues to trade in a pullback fashion of yesterday, but this pullback so far for the third time, it managed to survive at the 116.15 short-term pivotal support level that we highlighted. So still no change, still using this 116.15 short-term pivotal support level on the euro dollar to maintain this bullish bias view for it to retest the all-important resistance at 116.75 that can't surpass since last Thursday over here. So the first resistance to watch for sure will be 116.75. So only a clear break with hourly close above 116.75 will continue this ongoing minor bullish impulsive upmove sequence that has taken shape since the critical minor swing low of 6th of November, where this is forming of this potential double bottom formation, a minor double bottom formation, to expose the next intermediate resistance at 117.20 in the first step, which is the 1.236 Fibo extension of the first double bottom low at 6th of November, a minor double bottom low, and as well as the minor swing high of 7th of October and 17th of October this year. Only a bearish breakdown below 116.15 will trigger off a much more deeper minor corrective pullback sequence to expose 115.90 and even 115.50/115.40 level. Next, that's for the euro dollar. Next up will be the sterling dollar over here. So the sterling dollar also managed to help above our 50-day moving average and also confluence with the pivotal support level at 132.70, and as well as the lower limit of this ongoing minor ascending channel drawn from the low of 21st of November over here. All right, so all in all, what we could see is that the RSI also managed to bounce off from the oversold level yesterday, slightly above the oversold level. So what we could see is that I'll be still using the 132.70 as my short-term pivotal support, but the sterling dollar is much more weaker in terms of technical configuration, given the fact that it can't surpass the 200-day moving average, whereas the euro dollar continues to trade above its 200-day moving average in the last 1 month or so. So over here, given the fact that it's still below, it managed to dip down below the 200-day moving average today, I will have a higher first resistance level to watch in my continuation of that maintaining of that bullish bias view for the sterling dollar for a further recovery. So given the fact that it's still below the 200-day moving average over here, I will use this resistance level here. Oops, let me do a proper one. Yeah, this is the one that coincides with the 200-day moving average at 133.33. So 133.33 will be my first intermediate resistance level. A break above 133.33 may see a retest on last Thursday's minor swing high, pardon me, at 133.70. Only a bullish breakout above 133.70 will see a higher probability movement of this continuation of this minor bullish impulsive upmove sequence to resume towards the next resistance level at 134.15/134.50, which is the upper boundary of this minor ascending channel from the low of 21st of November, and as well as the 2-time Fibo extension taken from the low of the first minor double bottom on the 5th of November, and as well confluence with the minor swing high area of 16th of October and 17th of October. Only a bearish breakdown below 132.70 will invalidate today's bullish bias / recovery scenario on the sterling dollar to head down towards the 131.80/131.40 intermediate support zone, which confluence very closely to the 20-day moving average as well. So that's for the sterling dollar. Next up will be the Aussie dollar that continues to outperform. So the Aussie dollar yesterday almost hit our first resistance at 160.60. It's 66.60, pardon me, not 66.60, a bit tongue twisting. Printed a current intraday high during the start of the US session at 66.54. So the 66.05 is indeed a short-term pivotal support level, given the fact that there was a slight price dip before forming a hourly dragonfly doji candlestick formation after the RBA meeting has concluded over here and the issuing of the monetary policy statement before spiking up in line with, we call it reinforced by the hawkish press conference by RBA Governor Bullock. So what you can see over here is more like an intraday price consolidation after breaking above 66.60. So still no change, still using 66.05 as my short-term pivotal support level. A breakout above 66.60 will potentially reaffirm the continuation of this minor bullish impulsive upmove sequence to expose the next intermediate resistance level at 66.90 next, which is the minor swing high area of 17th of September. And only a bearish breakdown below 66.05 will negate today's direct bullish bias view to see a deeper minor corrective pullback to retest back towards the lower limit of this minor ascending channel that has been in place since 21st of November, 6580/6555, right over here, and also maximum 6537. So that is our key medium-term pivotal support level, which confluence with the intersection between the 50-day and the 20-day moving average, right? So that's for the Aussie dollar. Next up will be the dollar yen. So the dollar yen yesterday spiked up due to BOJ UDA remarks stating that BOJ may consider purchasing long-term government JGB bonds again to slow down the rapid rise in the longer-term JGB bond yields. So that causes the JGB to spike up above our upper neutrality range. So yesterday we have a neutrality range at 156.16, spike up above 156.16. Hit a high during the US session at 156.93 before inching downwards to today's Asia session. So where it retraces, it also retraces at this dotted gray line here. So this dotted gray line is in fact previously a key minor trend line support level drawn from the low of 29th of October. Previously did a bearish reaction on the 3rd of December and now managed to do a pullback or a negative retracement right on it on yesterday's late US session. So what I could see is that if we do the Fibo retracement of that previous minor decline from the high of 20th of November all the way down to last Friday Asia session low, that also came close with the 76.4 Fibo retracement as well, and so close with a previous key intermediate resistance at 157.15. So I'll be using 157.15 as my short-term pivotal support level over here, a short-term pivotal resistance level, pardon me, not support. So I'll be using 157.15 as my short-term pivotal resistance level to flip back to a bearish bias for at least a minor retracement back to retest the 20-day moving average at 156 figure level right now. A breakdown below 156 figure level will potentially invalidate the bounce that has taken shape from the low of 5th of December. So indicating that this 5th of December bounce is more likely a corrective rebound rather than the start of a bullish impulsive upward sequence for the dollar yen, where we start to see a break below 156 may expose the next intermediate support level at 155.35, 154.90. Only a bullish breakout above 157.15 will see a continuation of the squeeze up towards the next resistance level at 158 figures / 158.35. Next, maximum 158.80, which is my medium-term pivotal resistance level on the dollar yen. And this 158.80 is very crucial. Why? Because this 158.80 previously managed to see induction of the intervention that has taken shape on 2 occasions on the 11th of July 2024 at around this 158.80 level, and also on the 26th of April 2024 around at the 158.80 level, where MOF, the Ministry of Finance, instructed BOJ to intervene in the FX market by selling dollar and buy up the yen in these 2 instances. All right, so definitely the 158.80 forms a rather key sentiment level to watch out for. That will be my medium-term pivotal resistance level. So that sum up all the intraday technical outlook on the 4 major US dollar pairs. So let us now proceed to the major stock indices, starting with the Hong Kong 33, representing the Hang Seng Index. So the Hong Kong 33 remains weaker for the third consecutive session. So what we could see is that the Hong Kong 33, that representing the Hang Seng Index, is down today as well. So what we could see over here is that it's now fast up. Yes, yesterday we have a bearish bias. So bearish bias hits our first support level already at around the 25,400 level, now heading towards the critical 21st of November minor swing low. So, and also what's interesting over here is that price actions shape a lower low right now as we are speaking. Okay, a lower low over here, but the RSI now has managed to show a bullish divergence. All right, indicating that this downside momentum has started to slow down and also fast approaching our second support level that we highlighted yesterday, which is at 25,150 in our bearish bias update yesterday. So given this bullish divergence that has been flashed out on the Hong Kong 33 on the hourly RSI, that could be at least a minor bounce in today's Asia session. So I will flip to a intraday bullish bias for this potential minor bounce to take shape using 25,150 as my short-term pivotal support level. Bounce resistance level to watch out for 25,660, which was the former minus support level from 3rd of December and 8th of December, Monday, taken down yesterday, slash 25,830 level, which is also very close to the 20-day moving average. So this will be the bounce resistance to take note of over here. So definitely, in order for the boost to have better traction going forward, it got to clearly break above 26,275, 26,310 going forward, which is also the former minor ascending channel support level drawn from the low of 10th of October and got rejected a couple of times since 2nd of December and as well as 5th of December on last Friday. However, a bearish breakdown below 25,150 will continue the intraday weakness towards the key support area of 24,765 and 24,765 slash 24,620, which is the lower limit of our medium-term pivotal support zone. That also confluence with the 200-day moving average. So that's for the Hong Kong 33. Next up will be the Japan 225. So once again, the Japan 225 managed to face a stubborn near-term resistance level at 50,985. In today's Asia session, has an intraday break but can't have an hourly close above it before selling off at the 9 a.m. mark Singapore time. So but managed now to stage a bounce again over here, or you could see over here there's a minor bounce taking shape according to this white little candle here, right exactly at right above at the pivotal support level that we highlighted previously, which is this 50,150, 49,960. So indeed here, this is somehow support level that the Japan 225 representing the Nikkei 225 that managed to see some form of support coming in. So it's more like now it forms a minor range. So this minor range top is at 50,095. Minor range bottom will be our short-term pivotal support zone that we highlighted previously. So still maintain that bullish bias to play this sideways range configuration, minor sideways range configuration since the high of 4th of December using the pivotal support zone at 50,150. 49,960 resistance level will be the upper limit of this minor range resistance at 50,095. Only a bullish breakout above 50,095 will solidify the continuation of the bullish impulsive upmove sequence to expose the next near-term resistance level at 51,530 in the first step, which is the minor swing high area of 4th of November, 11th of November, and 13th of November over here. So that's for the Japan 225. However, a bearish breakdown below 49,960, which is also a breaking down below the 20-day moving average, will see a deeper slide to retest the lower limit of this medium-term ascending channel drawn from the low of support, medium-term ascending channel support drawn from the low of 7th of April 2025 low at 4,985. That also confluence with the rising 50-day moving average closely as well. So that's for the Japan 225. Next up will be the Germany 30. So the Germany 30 managed to hit our first resistance level at 24,140 before shaping a mild consolidation pattern. So with that, I'll be using the lower limit of this ongoing minor ascending channel drawn from the low, minor ascending channel support drawn from the low of 21st of November and so confluencing at the 50-day moving average, acting as the first resistance level at 24,007 over here. So first resistance level to watch will be yesterday's high, right over here at 24,190. Excuse me. Pivotal support, I will adjust it slightly higher at 23,860. All right, so as long as this pullback didn't surpass below adjusted pivotal support at 23,860, still maintain that bullish bias on the Germany 30 after 24,190 will potentially expose the next intermediate resistance level at 24,395. Only a bearish breakdown below 23,860 will invalidate today's direct bullish bias view to see a deeper corrective pullback towards the next intermediate support level at 23,670, which confluence with the 20-day moving average. All right, so that's for the Germany 30. Next up will be the US Wall Street 30, representing the Dow Jones Industrial Average. So Dow Jones Industrial Average also stuck within this sideways range configuration, a minor sideways range configuration since last Thursday high at 48,000. And right now, yesterday, it floated back down towards the short-term pivotal support level, a tightened one that we have since the start of this week. So no change, still looking at 47,560 as my short-term pivotal support level. Price action got to break out above 48,000 to increase the start of a bullish impulsive upmove sequence for the US Wall Street 30 to seek out a retest in next step at the current all-time high area, which is also the 0.618 Fibo extension taken from this ongoing impulsive upmove sequence starting from the low of 21st of November. That will be at 48,450. Only a bearish breakdown below 47,560 will see a deeper corrective pullback towards the next support zone at 47,180/46,810. That confluence with the 20-day and the 50-day moving average closely as well. So that's for the Dow Jones Industrial Average. Next up will be the S&P 500. So the S&P 500 managed to also trade sideways below the 6,880 first intermediate resistance level. That can't break out since this Monday onwards. So still no change. 6,807 will still be my pivotal support level to maintain this ongoing bullish bias. A break above 6,880 potentially seek out the current all-time high at 6,930 in first step, which is the current all-time high of 29th of October and 30th of October area, and also the 0.382 Fibo extension taken from the ongoing impulsive upmove sequence from the low of 21st of November. Only a bearish breakdown below 6,087 will see a deeper corrective push down towards the 20-day and the 50-day moving average intersection, also confluencing with the next intermediate support zone at 6,780, 6,760 over here. All right. And what's interesting over here is that the RSI has started to shape a higher low, all right, indicating some form of momentum, positive bullish momentum coming back into the picture. All right, lastly will be the Nasdaq 100. So Nasdaq 100 also trade in the tight sideways range over here. Can't have a proper bullish breakout above the first resistance level at 25,760 since Monday, but managed to hold above our first support level at 25,580 in the last 3 sessions. And no change with that. Pivotal support still remains the same at 25,455. Still looking for a bullish bias view on the Nasdaq 100, supported by a series of rising higher low on the hourly RSI, indicating that positive momentum has started to creep back for the Nasdaq 100, despite the sideways price movement that is being seen since Monday. So a breakout above 25,760 for sure will solidify the ongoing bullish impulsive upmove sequence that has taken shape from the low of 21st of November, seeking out the next intermediate resistance in the first step at 26,070, which is the minor swing high area of 3rd of November. A breakdown below 25,455 will invalidate today's direct bullish bias view to have a much more deeper minor corrective pullback to be traced back to the 20-day and the 50-day moving average, acting as a near-term support level or confluencing with a graphical near-term support level at 25,305, 25,185. All right, so that sums up all the intraday technical outlook on the major stock indices. So all the major stock indices are trading above their respective key pivotal support level ahead of the FOMC meeting and as well as the release of the new economic projection dot plot thereafter. Now back to the technical analysis outlook. So let us now proceed with Gold XAU/USD. So Gold in the last few days, it starts to trade in a very tight range and its volatility has hit a 2-month low over here. So for gold, just basically it's now potentially doing a kind of a symmetrical triangle range configuration. If we were to look at it potentially in this way. All right. Okay, a rather choppy symmetrical triangle range configuration, a minor one. So with that, I will be still using the pivotal support level at 4,150. All right, which is very important. Why? Because this level also coincides with the rising 20-day moving average as well. 4,150 short-term pivotal support level, still maintaining that bullish bias within this kind of complex rangy configuration, with the first resistance level to watch out for will be at 4,267. Only a breakout above 4,267 will increase the probability of the start of a new minor impulsive upmove sequence in first step first to expose the next intermediate resistance at 4,340, slightly below 4,380 current all-time high that was previously printed on the 20th of October. However, a bearish breakdown below 4,150 will start to see another round of choppy corrective pullback sequence unfolding, exposing 4,105 in first step. If 4,105 can't hold, potentially it will take us down lower to the critical minor swing low of 20th of November, 21st of November and 24th of November, where the bulls managed to survive before kickstarting this minor rally that has taken shape in from late November to early December. That will be at support at 4,038. So that's for gold XAU/USD, still maintaining that bullish bias, but we in this kind of sideways complex range configuration using 4,150 as my short-term pivotal support for gold. Next up will be the West Texas crude oil. So West Texas crude oil plummeted as expected after hitting the upper limit of this minor sideways range configuration that has been in place since the low of 21st of November. So with that, it already come back down and hit our first support level at 58.35 over here. This level has already been met. So I will tighten my short-term pivotal resistance level to close to the 20-day moving average over here at 59.40 to be bearish in any potential bounces, given the fact that the RSI has started to leave the oversold level. So first resistance level to watch over here will be this former minor swing low area, all right, of 58.73, slightly below 59.50. That is my Titan short-term pivotal support level. Next resistance level to watch will be the minor range support area that has been in place since 21st of November at 57.54/57.31. A breakdown below it potentially exposed 56.8. So this is the key medium-term range support that has been in place since the low of 17th of October this year. All right, 56.80. Only a bullish breakout above 50.50 will negate today's bearish bias view to see it floating up to retest the upper limit of this minor sideways range configuration at 60.10/60.40. All right, so that's for West Texas oil. So before we go, right, other than the FOMC meeting today, what other key economic data that we should be taking note of over here? So today, just a while ago, we had the release of China inflation data. So it's rather a mixed bag over here. So the inflation rate rose above the inflation rate rose much more within expectation. Market is expecting 0.7% year on year for the month of November. It came in exactly at 0.7%, which is higher than the 0.2% that was printed in the previous month of October. So if you look at the trend of the inflation rate in China, it has slowly recovered over here. So this spike up of 0.7%, making it the highest number, all right, since February 2024. So you look at the 10-year trend, it's actually slowly picking up. But on the other hand, the factory gate prices, where we call it potentially business cost inputs. So business cost input, the PPI, producer price index, has came in slightly below expectation. So which is market is expecting at -2%, all right, but it came in at -2.2% and 1 basis point below the previous October print of -2.1%. So it seems to us that PPI hasn't really recovered yet. So indicating that it's rather a mixed reading in terms of that deflationary risk environment that that kind of hasn't kind of confirmed eradicated from the Chinese economy. So that also explains why the China stock market / the Hang Seng Index continue to be in the red, but they're coming very close to support level, especially on the Hong Kong 33, which I shared with you guys earlier on the intraday outlook. So ahead of the FOMC meeting, for those who have interest in the dollar, Canada dollar, the dollar CAD and the CAD crosses, we have a Bank of Canada interest rate decision, which is out at 10:45 p.m. Singapore time, and at 11:30 p.m. Singapore time, we have the Bank of Canada press conference as well. Then thereafter, for those who have interest in the oil, so oil price at 11:30 p.m. there will be an impact on the WTI crude oil price due to the weekly EIA crude oil stockpile change data that could have some form of intraday impact on the West Texas crude oil. So that will be at 11:30 p.m. Singapore time. Then nevertheless will be the 3 a.m. mark over here. More or less, like I explained, that market has really penciled in almost certainty that the Fed will do a cut. So whether this cut of 25 basis points to bring it down lower to 3.75%, whether will be a hawkish cut or a dovish cut going forward, is all pens down on the dot plot, the latest dot plot projection, which I shared with you guys earlier on my take during the first segment of today's daily note. So that will also be out at the same time of the Federal Reserve interest rate decision outcome at 3 a.m. And then thereafter, market will focus on how Fed Chair massage his messaging during the Q&A session, during his press conference. That will be at 3:30 a.m. Singapore time, and that could also create volatility in the global markets. All right, so that potentially sum up today's daily dose of market insights. And for those who have the Aussie dollar, bear in mind that we have a key Aussie dollar data, tier 1 data, that is more pertaining to the labor market. So labor market continues to be rather firm going forward. So that will be at 8:30 a.m. Singapore time. In terms of employment change, previously was at 42.2. This time around, market is expecting a low ball number. So any number that is higher than this low ball number could potentially see Aussie dollar firming up again. And the unemployment rate right now is slightly up, slightly from 4.3% to 4.4%. So that will be at 8:30 a.m. Singapore time. So with that, that sum up today's daily dose of market insights. I'm Kelvin here signing off. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.